Every generation has a turning point, a moment when the system resets and the rules of money are rewritten. For our generation, that moment is coming sooner than most expect. Economists call it a correction. The media calls it a slowdown. But history calls it what it truly is, a crash. And this one, the 2026 market crash, might be the biggest economic shift in our lifetime. Now that sounds terrifying. Billions lost, portfolios wiped out, panic in the streets. But if you look deeper, you will see something that very few people ever notice. Every great crash in history has not only destroyed wealth, it has created it. The difference between the losers and the winners is never luck, it is perspective. Right now, the global economy is like a tower built on borrowed time. The debt is enormous, the valuations are insane, and the confidence that keeps it all standing is beginning to shake. The Federal Reserve is fighting inflation by tightening money. Interest rates are high, liquidity is drying up, and the cheap credit that fueled the last decade of growth is fading fast. And yet the stock market is still dancing like the party will never end. This is exactly how it always happens. In 2007, before the housing crash, everyone said the same thing, that this time it is different. In 1999, before the dot-com collapse, analysts said technology had changed everything. In 1929, before the Great Depression, newspapers said the fundamentals were sound. Each time, the world ignored the warning signs. And each time, the few who paid attention became legends. Warren Buffett once said that the best time to be greedy is when others are fearful. But he left out the most important part. You cannot be greedy during fear unless you prepare during euphoria. That is where we are right now. In the last phase of the euphoria. Corporate profits are under pressure, consumer savings are shrinking, and inflation is eating away at real income. But instead of slowing down, the markets are racing higher. Tech stocks are once again leading the charge. Artificial intelligence has become the new gold rush, and retail investors believe that every dip is a buying opportunity. Sound familiar? It should. Because this is exactly what the final stage of every bull market looks like. A calm that feels like victory right before the storm. The data is flashing red. Margin debt is near record highs. Corporate debt rollover costs are surging. Banks are holding losses on bonds that will take years to recover. The government is borrowing trillions just to stay afloat. Every indicator that once warned of danger is now being ignored. And yet, inside this chaos lies the biggest wealth transfer of the decade. When markets collapse, the headlines always focus on destruction. But the people who truly understand how cycles work see it differently. They see a clearance sale on the future. When assets collapse, value is not destroyed, it is transferred. From the impatient to the patient. From the panicked to the prepared. This is the secret that history has proven again and again. During the Great Depression, a few investors quietly bought distressed assets and built empires. During the 2008 crisis, while millions lost homes, a handful of firms bought real estate for pennies on the dollar. Those who had cash, courage, and clarity came out 10 times stronger. The crash does not make people rich. What makes people rich is how they position themselves before, during, and after it. That is why understanding what is coming is not about predicting doom. It is about preparing for opportunity. So what exactly could trigger the 2026 crash? It will not be one event. It will be a chain reaction. The cracks are already forming. Overvalued tech stocks, global debt at record highs, geopolitical tensions, and slowing growth. One spark could ignite the chain, and when it does, it will spread fast. Investors will panic, liquidity will vanish, and prices will fall faster than anyone expects. But that is also when everything changes. Because when fear takes over, logic disappears. Assets that once seemed untouchable suddenly become bargains. Companies that were once too expensive to own will trade at half their true value. That is the window where wealth is born. And it will not last long. In 2026, those who understand how to recognize real value will have the chance to buy the same assets that billionaires will scoop up quietly while everyone else is selling. The question is not whether there will be opportunity. The question is whether you will be ready to take it. Because make no mistake, the crash is coming. The signals are loud. Central banks cannot print their way out forever. Inflation, rate hikes, and falling productivity are painting the same picture that preceded every major correction. But the good news is that money does not vanish in a crash. It simply moves. The key is to be on the receiving end of that movement. If you can stay rational when everyone else is emotional, if you can prepare when everyone else is distracted, you can build wealth during the same event that wipes others out. That is not speculation. That is how every financial empire was built. And that is why, for those who understand cycles, the crash of 2026 is not a curse. It is a second chance. The market will reset. The fake money, the fake valuations, the over-leveraged bets, all of it will burn away. What will be left is the foundation for the next era of growth, the next wave of innovation, the next generation of wealth builders, but only for those who see it coming. Before we move to what that means in real terms, what assets to watch, how to protect your capital, and where the true opportunities will rise from, take a second to subscribe to Assets Amplify. Because this is where we decode the cycles of greed and fear that move the financial world and show you how to turn chaos into advantage. Part 2 of this story is where we get practical. The exact moves that separate the few who win from the many who panic. The assets that thrive in crises. The mindset that turns volatility into opportunity. The 2026 crash could ruin the unprepared, but it could also mint a new class of millionaires. Which side you fall on depends on what you do next. When the storm hits, it will not send you an invitation. There will be no clear moment when the markets say this is the crash. It will begin quietly. Maybe a few bad quarters. Maybe a bank collapse somewhere overseas. Maybe a bond default that shakes confidence, and then suddenly, the calm will turn into panic. The headlines will scream that it is the end. Investors will rush for safety. Politicians will blame each other. But history tells us that the real opportunity does not come after the panic ends. It comes right in the middle of it, because that is when prices detach from value. And when value detaches from price, wealth transfers. So how can you prepare before 2026, position during the chaos, and rise after it? It begins with understanding 3 things: liquidity, patience, and asymmetry. 1. Liquidity, the power to strike when others freeze. The first rule of making money in a crash is simple. You cannot buy opportunity without cash. During a boom, liquidity seems boring. Everyone is chasing returns, leverage, and high-risk bets, but during a crash, liquidity is everything. It is the difference between being forced to sell and being able to buy. The investors who became legends in 2008 were not the ones who had the best stock picks. They were the ones who had dry powder ready when the fire started. They bought when everyone else was trapped. That means now, before the crash, your priority should not be chasing the next hot stock. It should be building liquidity. Cash, short-term instruments, and flexible capital that can be deployed quickly. Because when the panic begins, prices will fall faster than logic. Great companies will trade at ridiculous discounts. Real estate will go on sale. Even commodities will drop before rebounding. If you have liquidity when that moment comes, you hold the most powerful asset in the market: choice. 2. Patience, the discipline to wait for value. The second rule is patience. Every crash has phases. First comes the denial, then fear, then capitulation, and finally recovery. Most people jump in too early, thinking they are buying the dip, but that first dip is rarely the bottom. The real value appears when people give up. When the headlines stop talking about recovery, when friends say the market is dead, that is when the greatest investments hide in plain sight. In 2009, after Lehman Brothers collapsed, there were 6 months when stocks were called toxic. People believed capitalism itself had failed. Yet that was the exact window when the greatest fortunes of the next decade were made. Patience does not mean waiting forever. It means watching the cycle with clarity. When valuations return to sanity, when panic turns to fatigue, that is your cue. 3. Asymmetry, small risk, massive upside. The third principle is asymmetry. During a bull market, most people take on massive risk for small gains. But during a bear market, you can reverse that small risk, huge upside. It means identifying assets that have limited downside because they have already fallen too far, yet huge potential if the cycle reverses. It could be a quality business trading below book value. It could be a piece of real estate sold under pressure. It could be a new technology that is temporarily ignored. Asymmetry is how small investors turn crashes into generational wealth. You do not need to predict every move. You just need to position yourself so that if the market recovers, your upside multiplies, and if it falls further, your loss is minimal. That balance is where real opportunity lives. The mindset that separates the few crashes are not only economic events, They are psychological events. Every investor says they will buy the dip. But when the dip comes and the red candles flood the screen, fear takes over. People say it feels different this time. They forget their plans. That is why you must train your mind before it happens. Fear is contagious. It spreads through news, social media, even casual conversations. The only antidote is conviction. Conviction built on data, not emotion. That means studying history. Every crash, every recovery. 1929, 1987, 2000, 2008, and even 2020. Each one followed the same rhythm. Excess, denial, collapse, despair, recovery. Those who see that pattern stay calm when others panic. They remember that no matter how bad it gets, markets recover, always. The key is to survive and accumulate while others retreat. Where the opportunities will emerge now, what kind of assets could lead the next recovery after 2026? Real assets. Inflation is not gone. It is only sleeping under the weight of manipulated interest rates and fragile credit systems. Every major economy has pumped money into circulation faster than productivity has grown. When the system cracks in 2026, governments will have two choices. Either let markets burn or flood them with liquidity to save the system again. History shows they always choose the second. When that happens, real assets rise first. Land, commodities, and productive property become safe havens once again. Gold and silver usually lead the rebound, followed by energy and industrial commodities. Then real estate and equities join the cycle later as confidence slowly returns. Smart investors position early. They do not chase rising prices. They accumulate when no one else wants to touch those assets. They understand that a system reset means a currency reset, and that means physical, tangible value holds power when paper confidence disappears. 2. Technology and disruption. Every crash destroys one industry and gives birth to another. The Great Depression wiped out traditional manufacturing but created the infrastructure boom. The 2000 dot-com crash killed thousands of internet startups but cleared the way for Amazon, Google, and Facebook. The 2008 crisis collapsed banking giants but opened doors for fintech and decentralized technology. The 2026 crash will likely do the same. It will expose overvalued tech, especially those dependent on cheap debt. But it will also open space for new revolutions: artificial intelligence infrastructure, renewable energy, quantum computing, and defense technology. When markets fall, the narrative shifts from hype to utility. Only the strongest and most necessary ideas survive. That is where wealth flows next. The investors who will become millionaires and billionaires from this crash are the ones already researching the next long wave of innovation while everyone else argues about rate cuts. 3. Debt and distressed opportunities. One of the greatest plays after every crash is distressed debt. When companies or governments default, their debt gets sold for pennies on the dollar. That is where institutional investors quietly build massive wealth. After 2008, funds like Oaktree Capital and Blackstone made billions buying bad mortgages and corporate bonds that no one wanted. They understood a simple truth: fear misprices assets far worse than greed ever does. You do not need billions to play that game, you just need awareness. Many retail investors overlook bond markets, distressed REITs, and corporate debt ETFs because they sound boring. But after 2026, when interest rates finally start dropping again, those very instruments could double or triple in value. Positioning before the storm: if 2026 becomes the year of correction, 2025 will be the year of setup. What you do before the crash will determine what you can do after it. Preparation is not about predicting the exact date. It is about recognizing the signals. Rising debt delinquencies, weakening job numbers, falling liquidity, and credit spreads widening. These are the whispers before the thunder. So here's how to prepare. Step 1. Simplify. Cut exposure to speculative bets. If you hold assets that depend on endless growth, unprofitable tech, over-leveraged real estate, or meme-driven coins, start trimming them. Crashes punish excess first. Step 2. Fortify. Build your liquidity position. It does not have to be all cash. It can be short-term treasuries, money market funds, or high-yield savings that give flexibility. The goal is to stay liquid enough to act when panic hits. Step 3. Research. Make your watch list before the crash. Study high-quality businesses that are currently overvalued but have strong balance sheets, essential services, and global demand. When the crash discounts them by 40 or 60%, you will not be paralyzed by fear. You will be ready. Step 4. Stay detached. Emotion is the enemy of wealth. In a crash, the market will test your patience, your conviction, and even your sense of reality. If you let emotion guide you, you will sell low and buy high. But if you stay rational, you will do the opposite. Sell the hype, buy the despair. Step 5. Educate. The most valuable asset in a crash is knowledge. Learn how to read balance sheets, understand macro trends, and identify real value. Because during chaos, analysis replaces luck. The great transfer of wealth. Every crash creates victims and winners. But more importantly, every crash transfers wealth from the impatient to the patient. In 1929, panic destroyed fortunes overnight. Yet those who quietly bought strong industrial stocks during the bottom went on to dominate the post-war economy. In 2000, most internet investors lost everything. Yet a small group of contrarians built the foundations of trillion-dollar companies. In 2008, millions lost homes. But investors with liquidity bought properties that multiplied in value over the next decade. That is the cycle. It never changes. The players change, the timing changes, but the rules remain constant. In 2026, the world will once again see this transfer. Those who are drowning in fear will sell their assets for cents on the dollar. Those who are prepared, liquid, and patient will quietly accumulate. But there is something new this time: information speed. Unlike previous crashes, this one will move faster. Algorithms, automated trades, and social sentiment can collapse or recover markets within days. That means hesitation could cost as much as ignorance. Preparation will not just give you advantage. It will give you survival. The myth of the safe zone. Most people believe safety means staying out of the market during a crash. But that is only half true. If you sit entirely in cash, inflation and currency debasement can still erode your wealth. If you stay fully invested, volatility can destroy your capital. The real safe zone lies in balance, part liquidity, part opportunity. Use the crash as a reallocation event. Exit what is inflated and enter what is undervalued. Shift from stories to fundamentals, from speculation to productivity, from promises to proof. That transition is where fortunes are made. Remember, every new financial era begins with a collapse of the old one. The crash does not end opportunity. It resets it. Psychology of the 2026 investor. To profit from a crash, you need to master not just markets, but also human behavior. When the market crashes, fear is amplified by the media. Analysts will predict a lost decade. Friends will warn you that investing is dangerous. Politicians will promise fixes that never arrive. But fear always peaks at the bottom. It is a signal, not a warning. If you want to see the future, look where fear is highest and logic is gone. That is where the greatest opportunities hide. This is why contrarian investors thrive. They do not follow the crowd. They understand that true wealth is built by moving opposite to emotion. While the world shouts sell, they whisper buy. While the world screams collapse, they quietly accumulate. And years later, when the headlines call it a miracle recovery, these investors are already sitting on life-changing gains. The cycle of confidence. When recovery begins, it does not look like recovery. It feels slow, confusing, and uncertain. Unemployment remains high. Consumers stay cautious. The news is still negative, but markets move before confidence does. That is why most people miss the start of every bull market. They wait for confirmation that never comes. By the time the economy looks safe again, the best opportunities are gone. So when the 2026 crash unfolds, pay attention not to what people say, but to what data shows. When selling slows, when insiders start buying, when volatility stabilizes. Those are the quiet signs of reversal. If you act before confidence returns, you capture the foundation of the next wealth cycle. The hidden edge, accumulation during pain. The hardest part of any crash is psychological endurance. You will see your portfolio down 30, 40, maybe even 60%. Every instinct will tell you to cut losses. But if you are holding quality assets, that pain is temporary. Those moments of despair are not signals to quit. They are signals to accumulate. Dollar cost averaging, steadily buying through decline, turns volatility into your ally. It transforms chaos into discounted opportunity. The truth is, markets are not designed to reward panic. They are designed to reward consistency. Those who keep buying while others stop will always come out stronger on the other side. The quiet millionaires, when the next recovery comes, most of the new millionaires will not be influencers or celebrities. They will be quiet individuals who stayed rational when others lost control. They will be people who studied past crashes, built liquidity, kept discipline, and invested when the world seemed lost. They will not owe their success to luck. They will owe it to preparation. If history repeats, and it always does, then 2026 will be remembered as both a year of collapse and a year of rebirth. The question is which side of that story you will stand on. If you have watched this far, you already have an edge. You are thinking ahead, not reacting to fear. You understand that the future belongs to those who prepare, not those who panic. So take a moment right now, hit subscribe, join the community, and make sure you do not miss the next video where we break down exactly how to build your crash portfolio before 2026 hits. Because wealth is not created by timing the market. It is created by understanding it. And the next great opportunity is closer than anyone wants to admit.